All right, let's dive into Alligo. They're a major industrial supplier in the Nordics. And believe me, they've been through a massive transformation. And now, well, now they're sitting at a critical crossroads. For any investor looking at this company, the question seems simple, but the answer, well, it's anything but.
So here's the big question, right? Is Alligo a classic deep value play? A solid company that's just been beaten down by a tough market and is ready to rebound? Or is it a falling knife? A company with some serious underlying problems that are only now starting to surface. To figure that out, we really need to get under the hood and understand the business. So first things first, let's break down what Alligo actually does. Think of them as a one-stop shop for Nordic businesses. We're talking everything from workwear and safety gear to tools and all sorts of industrial supplies. Okay, so where's the money coming from? This chart tells a really clear story. The business is heavily, and I mean heavily, tilted towards its home turf. Sweden is driving more than half of its profits. Norway and Finland make up the rest. So right off the bat, you have to understand, their fate is deeply tied to the health of the Swedish economy. That's a key piece of this whole puzzle. Now this is really the core of Alligo's entire strategy. It's like a tale of two different companies under one roof. On one side, you have the huge, integrated mothership, the Swedol and Tools brands. That's about 80% of their sales, all running on one big shared system for IT and logistics. Then on the other side, you've got this collection of smaller, specialized companies they've acquired, which all run on their own in these profitable little niches. This dual strategy is central to everything. You've got this giant, efficient engine, and then a bunch of smaller, faster boats out there looking for growth. So with that setup, let's look at the reasons to be worried. The bear case for Alligo isn't based on feelings. It's built on some very clear, pretty concerning numbers that have popped up over the last year or so. First up, this number. Negative 3.9%. That was their organic growth in 2024. What that means is, if you strip out all the growth from the companies they bought, their core business is actually shrinking. It's going backward. And remember how much they rely on Swedish industry? Well, that sector has been having a tough time, and this number suggests Alligo's main engine is really sputtering. The acquisitions, you could argue, aren't just for growth. They're masking a decline. Next up, let's talk about debt. As of the third quarter of 2025, the company's leverage hit 3.1 times. Now, the key thing here is that their own financial target is 3.0. When a company blows past its own debt goals, that is a huge red flag for investors. It signals real financial stress on the balance sheet. And this is what happens when you have that kind of financial stress. In 2024, the company took an axe to its dividend, cutting it by a massive 43%. A cut that deep sends a crystal clear message. We need to hold on to our cash to handle our debt and fund these acquisitions. Rewarding shareholders just isn't the top priority right now. And to top it all off for the bears, there's a big change at the top. In October 2025, the CEO who managed this entire incredibly complex integration is leaving. Now, the official story is, hey, the job's done, the platform's built. But if you're an investor, a CEO walking out the door at such a make-or-break moment, that adds a huge dose of uncertainty to the mix. But wait, that's only one side of the coin. The bull case says, hold on. All those negative points are what's in the rearview mirror. The argument here is that the worst is over and that Alligo is now perfectly set up for a really powerful recovery. So let's see how that argument stacks up. The whole bull argument really kicks off right here with what some people are calling the first green shoot. If you look at the Q3 2025 results, you see the first year-over-year improvement in their profit margin after six straight quarters of it going down. This could be the first real sign that all the painful cost cutting is finally starting to pay off and that profitability is turning a corner. See, the bulls will tell you that the really hard work is done. That multi-year, difficult integration created one unified platform across the Nordics. Sure, that platform has high fixed costs, which really hurt them during the downturn. But on the flip side, it creates massive operating leverage. What that means is, when the market finally turns around, even a tiny increase in sales could translate into a huge jump in profits. And hey, remember those acquisitions we talked about? While the core business was struggling, Alligo was out shopping for new growth engines. Here are just a few of their key moves into really profitable niches, like batteries and welding. From the bull perspective, this isn't a company trying to hide its weakness. This is a company smartly building brand new pillars for its future growth. So really, the bull case all boils down to these three things. First, you've got a strong, stable, long-term owner in Nordstjernan, which is a big deal. Second, the stock's valuation looks pretty reasonable if you believe that earnings are going to recover. And third, and this is the big one, that coiled spring of operating leverage, just sitting there waiting for the market to pick up. So we've heard both sides of the story. The bear case of a shrinking core business under a lot of financial strain, and the bull case of a streamlined company just waiting for a cyclical rebound. So as an investor, what are the key metrics you need to watch to see which story wins? Okay, this is it. This is your investor checklist. Number 1, organic growth. That number has to turn positive. That's how you know the core business is stable again. Number 2, adjusted EBITDA margin. Was that Q3 improvement just a blip, or is it the start of a new upward trend? 3, the leverage ratio. They have to get that number back below their 3.0 target. And finally, number 4, the new CEO. The person they choose and the strategy they bring could be the single biggest catalyst of all. So there you have it. The platform is built, the economic downturn has hit them hard, and the very first signs of a recovery might just be on the horizon. The risks are incredibly clear, but so is the potential reward. The question for any investor looking at this is, now that you have the facts, where does this story go from here?